Good evening, everyone. It's Wednesday, the 25th of February evening, which means for those of us who are employed doctors, it's payslip day. And because we are towards the end of the financial year, at the end of month 11, it also means that we're in a very good position to estimate taxable pay and therefore estimate something called threshold income and something called adjusted net income, which are both really important concepts to understand for tax planning. So in this video, I was just very simply going to go through the process of calculating threshold income because it's something that causes a lot of confusion, starting from first principles with payslips. And also I'm going to talk about adjusted net income, which uses a lot of the same principles as well. So just moving over to an example payslip. So these came out today for the period end date to 28th of Feb 2026. So this is pay period 11. So this means that on the left hand side, the year to date bit covers 11 months pay. And then in the period summary, this shows the pay, both pensionable pay and taxable pay, that were earned in this month. And because this is the 11th month and therefore there's only one more month in the tax year, i.e. March, you can estimate your complete taxable pay by simply adding these two figures. So year-to-date taxable pay in the first 11 months and then the period taxable pay in the 11th month. That should give you an estimate that's pretty good for 12 months. Now, it's particularly good if your pay is stable, i.e. you're not due an increment and you don't have a variable number at WLI shifts or overtime. And if that's the case, you'll need to make a more manual estimate of taxable pay. And I've also updated my modeler to include the February payslips as well. So again, you can put in the information from that for year-to-date pensionable pay, period pensionable pay, and then that will give you a really accurate estimate of pensionable pay in the year-to-date. So moving on to threshold income for employees. Now this is something that around this time of year and also kind of around January and people working out what their tax liabilities are, people get themselves in a bit of a muddle over. So I'm going to show you a simple way that I use to approach threshold income. And I'm going to base it on the starting point of a February payslip. So as I said, the year-to-date taxable pay in those 11 months is this value of red, and this is the period taxable pay. So if we add those together, that is going to give us an estimate for the 12 months NHS taxable pay. Now, because this is taxable pay and the way that the NHS pension scheme works, there is no need to deduct the employee contributions because they've already been deducted. So you'll see here that the gross pay is higher than the taxable pay, and that's principally because the employee pension contributions have already been removed. So using this approach, starting with taxable pay, it's really important that you don't remove the employee contributions again because they've already been removed. And similarly, don't use the value for gross pay on this payslip or the value for pensionable pay because you'll get very different answers. So the crucial one to go to is taxable pay, and this is what equates to the P60 value for March. So your March year-to-date taxable pay will be the same as the value that's on your P60. Now, of course, threshold income and adjusted net income also need to include taxable income from any other source. So for example, if you get income from property, if you get income from bank interests, if you get dividend income, if you get income from private practice or non-NHS income or other benefits in kinds, then you need to add that to the value for your NHS taxable pay plus the income from any other source. And then we can move on to step 3, which is removing any employment related expenses. So for example, General Medical Council, BMA, Royal Colleges, etc. So things that you normally would claim via your tax return as allowable expenses can be removed from this value as well. Now, finally, for calculating threshold income, if you've contributed towards a private pension, so this is not the NHS pension, so that if you've got a SIP, then you can also deduct the gross amount, and I'll explain to you why that's really important in a minute. So for the purpose of threshold income, we're going to completely ignore gift aid, and I'll come back to gift aid when we talk about adjusted net income in a minute. And importantly as well, we don't add anything back in, for example, salary sacrifice. If you've got a car lease or bikes or childcare, you don't add those back in. So that will give you your threshold income. And there is a threshold income test, which is if it's above 200,000, you then need to calculate adjusted income. And adjusted income essentially is going to be your threshold income plus your pension growth. Now, of course, pension growth is something that normally comes in a brown envelope after the tax year has closed. So ordinarily, if we had pension schemes that were doing what they're meant to be doing legally, which I'm not entirely sure we're in that position at the moment, but if they were doing what they're meant to be doing, you would get a brown envelope if you exceeded the annual allowance in the October after the tax year is closed. Now, of course, if you want to look at what tax planning opportunities there are and know your position and know your numbers, it's of really very little value to know it after the tax year is closed. So what you need to do is estimate your growth, and I'll show you a couple of tools, including my own, to estimate your growth for free. Now, step 9 is if in that step above about a SIP, you had contributed towards a SIP, now is the point where you've got to add that back in, because that's a pension contribution and that will be subject to pension taxation, like the growth from your defined benefit pension. And then we come to another test, the adjusted income test. And if adjusted income is greater than 260, you taper. So let's just give a worked example. So we'll take that payslip from that initial screen, and we're starting off by just adding year-to-date month 11 taxable pay plus period pay, and then we get an estimate here of 186,714.33. We then go to step 2, and in this case this person's got £200 bank interest, and they've got £21,000 of other income, and then adding all of that together plus the taxable income up here, we get to £207,000 and £714. We then can take off our MDU, GMC in college, and that comes to 205,714. I've just noticed that my arithmetic is slightly out, but I'm going to run with it anyway, because this, of course, adds up to 21,200, so that would have gone to 186,914. 207,914, but it doesn't matter. The final answer is right. We've got no SIP, we've got no gift aid, but even if we did, we would ignore gift aid, and we're going to ignore a salary sacrifice. Now, because the this figure here, 205,714, is above that 200 test, we then need to go on and calculate adjusted income, and we do that by taking that 205,714. We're going to add in the estimated growth. So this has come from a modeller, so it could be the NHS employees modeller, for example, or my own modeller, and it's got estimated growth for this member in this tax year of £102,000, and that comes to adjusted income of 307,714, and there's no SIP to add in here either. And again, because that fails the adjusted income test of being above 260, we then have to take off that 260, and we're left with this excess of 47,000. And because, a bit like the tapering of the personal allowance, we every £2 of the excess we lose £1 of annual allowance. It means we've got a deduction of 23,857, and if we take that off the new higher annual allowance of £60,000, we're left with a tapered annual allowance of 36,142. And as per the title, this is somebody with large growth. They've incremented this year. There's no carry forward. They've just tapered. There's no SIP. So we start off with this PIA of 102. We take off the allowance, including carry forward, which was 0, of 36,000. And then we've got this very large excess of 65,857, which will of course be taxed in England and Wales and Northern Ireland at 45% and higher if you're north of the border, and that gives an eye-watering tax charge of 29,635. And so the question is, why do you need to know this depressing figure in February when you've just paid a large tax bill in January? So what's the point of knowing it? And the point of knowing it is, if you know your numbers, you can do something about it. And one of the things that you can do about it, even very late in the tax year, even after your March payslip has come, is pay into a pension. Now, I hear people shaking their YouTube video and saying, you've got a tax charge of £29,000, why on earth would you want to pay into a private pension? And this is why. So if we fast forward to the next slide, and the figures were exactly the same up to this figure, 205,714. But if you remember, we take off the gross payment towards a SIP. So if we've got a SIP of 6,000, that 205 figure becomes 199,714. And because that figure is the correct side of £200,000, we no longer exceed the threshold income test, and we therefore don't need to calculate adjusted income. And because of that, we've got a full annual allowance of £60,000. And therefore the excess is now 48,000 and the tax charge is 21,600. And I apologise for the other typo in these rapidly made slides because there's an extra zero in there that shouldn't be there. So the annual allowance charge without a SIP is 29,000, but if we put 6,000 in a SIP, the annual allowance charge has decreased by £8,000, over £8,000, despite the fact we've put another £6,000 into pension saving. So that is, of course, all good. So now moving on to adjusted net income, and adjusted net income is very similar to threshold income. So we would have done all of those initial steps by adding the year-to-date pay and the period taxable pay and on a February pay slip to estimate the taxable pay. As before, we've already deducted employee contributions from that, so do not deduct those again. Add in taxable pay from any other source, take off employment-related expenses. If you contributed towards a SIP, then you can deduct that amount there. But unlike the taper calculation, the threshold income calculation, we do deduct gross gift aid donations. So you basically got two options. If you're not going to reduce your income, so in this example, we've changed the income to 105,714. So we're just above that £100,000 cliff edge. And then we can see that we can either put some money into a SIP, so that's the difference between this one and this one. The £6,000 has gone into a SIP, but we could have done the same with a gross gift aid combination. And because we take off the gift aid donation, we can see that 105,714, and this example means that we've got adjusted net income down to 99,000 instead of 105,000. And in this example from my modeler, and I'll go through the modeler in a second, we can see that this person's got total childcare costs of £12,000 a year, but if they trip over 100k limit, and it is a cliff edge, you only need to go over by a penny, this member would have lost £5,000 in tax-free childcare. So we can see their position after childcare is very different. So with the income at 105 and no SIP, after childcare and tax and NI, they've got 58,732 to go into their bank account. Whereas if they don't trip over that 100k threshold by making a SIP contribution, then they've got 61,395. So a significant better position between 58 and 61. But crucial to using this strategy is knowing if you have the headroom. And so that's where it kind of comes back to pension modelling again. You need to know if you've got any carry forward, so you need to know your previous year's pension growth, and you need to know what headroom you've got after your NHS growth. So this member had 6,200 headroom, so it was a very easy decision to say, let's just put some money into a SIP, let's not trip over that, and then they're in a much better position. And that 6,000 into a SIP is it means that you pay £4,800. The government automatically tops it up with £1,200, and because you're kind of in this magic zone with very high marginal rates, it means you can claim the extra relief, in this case 2343. So that £6,000 of pension saving is actually only ended up costing you, after all of the reliefs, around 2,500, 2,457. So again, a little bit of a no-brainer. So just going back to the various modelers, as I said, First Actuarial and NHS employers have got a modeler. Unfortunately, they still aren't doing 2008 pension modelling, which has been temporarily removed after we let them know that the output of that was incorrect versus our modelling. But if you just after pension growth, you can use my modeler, bit.ly/GPFT interest, completely free to get just your pension growth. But I'm just going to show you some premium features now from the modelling. So we're just going to kind of go back to those two examples. So we'll start off with the tapered example. So we've got this bit which is an optional helper for calculating taxable pay in the modeler, and you can see here that was the figure that we got from adding together those values of taxable pay to that 186,714. We had that 21,200 extra income, and then we've got the employment rebates back for GMC, MDU, etc. colleges, and that made our taxable income 205,714. And then you'll remember that we had this very large tax charge of 29,636, but all of this is now being worked out for you. So for example, that tapered reduced annual allowance of 36,143, the tax charge is all there, and then you can look at the options. So for example, if you just remember, look at that charge of 29,636, and if we add in pension savings of 6,000, again we can see that that goes to 21,600, and that's including the tax charge on that private pension contribution of £6,000. So it puts you in a much better position, and really easy to see how the analysis works. And we've also got this really nice chart and table, so we can see if you don't taper for this member in this tax year, so I'll just take out that tax charge. So if we don't taper, we've got an AA charge of 18,900. If we do loads of WLIs and extras and bust that waiting list, that 18,900 charge becomes 41,400 at income over 258. But even by just going a penny over the taper with the ridiculous tapered annual allowance, you can see there's a taper cliff impact of 9,450, and that's why it's just such a damaging aspect of the pension tax system, because you fall over this cliff edge. But this will show you how to mitigate that. So just bringing things back down to earth again. So we'll take the lower paid example. So again, we've got that income. We're starting with 107,914. We've got no other additional income in this case. We've got the employment tax rebate of £2,200, the same MDU, GMC, MDU, etc. There's no tax charge for the 25-26 tax year in this example, but coming down to those screen captures that I've shown you already. So if we just scroll up to the bit that you can see now, so we can put in total cost of childcare lost. If you trip over that 100k, you could add in student loans, etc. If you've got a student loan as well, to see what the student loan position is, and we can see here that after childcare at the moment, we've got this figure of 58,732. We've got this headroom of just over 6,000, and that means we can put a SIP in for 6,000, and we can see that after childcare that's gone up to 61,395, and we can see the cost of going into the SIP. And then there's these really nice charts based on the IFS chart showing exactly the same thing. So I think the kind of the moral of the story is that it's really in your financial advantage to know your numbers. and it's really important around this time of the year, as we get closer to the very end of the tax year. You can make much more confident decisions by knowing what your threshold income is or your adjusted net income, knowing if you've got any headroom to look at options like SIPs. Obviously, there's limited ability to reduce your income at the very end of the tax year in the same way that there might be for looking at kind of planning for future tax years. But the moral of the story is if you know your numbers, you're in a much stronger position. So just that URL again, if you go to bit.ly/GPFT interest, you can get the growth modeler completely for free. And then we've got a number of premium modelers and also a concierge service where for a tiny cost of 11880 or just over the equivalent of 33p a day, we can do all of the growth calculations for you, and then you can just add in your income, etc., to get all of that done for you. So please don't just bury your head in the sand and ignore it. Don't just wait for your brown envelopes, because if you're just waiting for brown envelopes, they might not come based on recent performance. They may be incorrect, but also it's too late. Knowing in October after the tax year is closed means that you can't mitigate it. And finally, of course, what all of this is about is financial education. Knowing your numbers and knowing what they mean is crucially important to allow you to plan your own finances and potentially also make very significant savings in tax. And to that end, I've teamed up with Medics Money, and if you go to medicsmoney.co.uk/NHS-pensions-tax-traps-course, you can see that I'm doing a course with Andy Power, who's a veteran medical accountant of 30 years, and Tommy from Medics Money and the rest of the team. It's going to be a live course with smaller numbers, so people can kind of interact and ask questions, and also join their community of experts as well to ask further questions. So if you want to know more information about that, head over to the Medics Money website, and as I said, medicsmoney.co.uk/NHS pensions tax traps course. Thanks for your attention.